In September 2008, a 158-year-old bank collapsed overnight. Hundreds of billions of dollars vanished. Millions of people lost their jobs, and retirement accounts were wiped out. The global financial system stood on the edge of total collapse. But this story did not begin in 2008. It began years earlier with a simple, convincing idea, one that fit perfectly on a billboard. Why rent when you can own? In 2002, America was still reeling from the dot-com crash and the shock of 9/11. Confidence was shaken. Wall Street was nervous. To prevent the economy from stalling, the Federal Reserve slashed interest rates to near zero. Money became cheap, borrowing became easy, and slowly homeownership transformed from a necessity into a national obsession. Banks began offering loans to almost anyone: adjustable rate mortgages, balloon payments, ninja loans, no income, no job, no assets required. People were approved for mortgages far beyond their actual ability to repay. Homes were no longer just places to live. They became symbols of success, dreams of wealth, and tools for quick profit. Housing prices surged. Everyone believed prices could only go up. People flipped houses like trading cards. Speculation replaced caution. The market looked unstoppable. But beneath the surface, the system was dangerously fragile. High-risk mortgages were bundled together and sold as safe investments. These bundles were stamped with AAA ratings by rating agencies. Investors around the world bought them, believing they were secure. Then even more complex financial products were built on top of them, multiplying the risk while hiding it deeper inside the system. A few voices raised concerns. What would happen if homeowners stopped paying? What if housing prices fell? The answer, Wall Street believed, was credit default swaps. Financial insurance meant to protect against failure. But instead of reducing risk, they magnified it. When the system began to crack, the damage spread faster than anyone could control. Then the music stopped. Mortgage payments were missed. Foreclosures surged. Empty homes flooded the market. Housing prices collapsed. The carefully constructed financial tower began to crumble. Lehman Brothers fell, and with it, the global economy shook. Banks froze lending. Credit disappeared. Businesses failed. Families lost homes, savings, and futures. Governments rushed to save financial institutions, pumping billions into Wall Street. The banks survived, but Main Street did not. Jobs did not return overnight. Trust did not recover easily. For millions, the damage was permanent. The crisis of 2008 taught the world a brutal lesson. The most dangerous crises never look dangerous at the start. They look safe. They look profitable. They look normal until suddenly they